Hello, chart watchers, and welcome to this Wednesday, June 5th, 2019 Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Taking a look at the market today, we are bouncing pretty nicely so far. We've got the Dow Jones Industrial Average up 148 points. The S&P 500 is up 13, the NASDAQ up 31, and the Russell 2000 actually lagging today, down 5 points. 10-year Treasury yield trying to bounce off of the recent lows, still in this overall downtrend, but we are up about a half of a basis point to 2.12%. Volatility index continues to decline. We are now at probably about a week and a half low here. Utilities leading to the upside, along with real estate and consumer staples. If you're not familiar with this, these are three of the defensive groups. I don't like to see leadership on an up day coming from defensive stocks. Energy to the downside, getting hit hard by crude oil, which at last glance was down about 2.5% today, down near $51 a barrel. That is putting renewed pressure on energy stocks. Transportation, though, however, is moving up with the lower crude oil prices, and you can see both airlines and railroads performing well, and especially railroads moving back up above these key moving averages. Coca-Cola, best performer in the Dow. This is actually a pretty nice breakout. It only shows the last couple of months here, but this was a pretty nice area to clear above $50. So that one's looking good. Campbell Soup also making a breakout. They reported earnings this morning. Market likes what it sees. Okay, Erin, we talk a lot about sector rotation. We just talked about it yesterday, and now today the market's moving up and defensive stocks leading. What do you think?
Well, I've been concerned about weakness all along. I mean, yesterday it was those aggressive sectors. Maybe it's just the turn. It's the defensive sector's turns. But typically, and I know we talk about this a lot, that's kind of not what you want to see at the beginning of a price reversal or possible, rally continuation.
Well, and especially, I'll pull up a chart in just a bit, but the S&P 500 now is rallying, and it's going to be testing its 20-day moving average. Almost got there earlier today. And again, I don't like that. I don't like, I'm looking to see whether or not we can break out. And I know it's just the 20-day, but you got to start somewhere. Mm-hmm. And I don't want to see that leadership coming from defensive stocks on an attempt at a breakout. So, yeah, I'm not very bullish given what's going on, even though the market is higher.
Yep, I'm right there with you. I'm glad to have you joining the club.
Well, it's short term. I'm very bullish. Remember, I'm a fairly short term trader, swing trader. So the short term direction of the market matters to me. But my big picture, I'm still very, very bullish equities, and I think we go higher. But we're going to get into all that in just a couple minutes. But I do want to introduce a special guest today. We've got Jesse Felder with us. Jesse, your first time on Market Watchers Live. Welcome to the show.
Hey, thanks for having me. I'm excited about it.
Yeah, and I know you're going to be talking about how you use stock charts, which I think is a great topic because normally when we get our guests in here, they focus more on just the overall market, but you'll be giving us both. And I think that'll give our viewers a lot of great information. So looking forward to it.
Yeah, thanks. I've been a subscriber to stock charts for probably 15 years or something. So I've been refining my process over the years. So I think that might be helpful to see how, for other people to see how I use it.
Yeah, I think it'll be a great maybe learning exercise for a lot of folks maybe that are new to stock charts and different ways to use it. So definitely looking forward to your presentation. So hang in there with us for about 15 minutes. We'll bring you back, and then everyone will get to enjoy your presentation.
Sounds good.
All right, Erin, I think we should let's go. Take it away.
Yes, let's do it. All right, our upcoming schedule. Tomorrow, Dave Keller is going to join the show, and we're going to have a roundtable about Bitcoin and gold. So you'll want to tune in for that tomorrow. Tom has a workshop on Tuesday of next week. Tim Ord of the Ord Oracle will be in with us on Wednesday. And then, as I continue to say, mark your calendars, June 13th, the John Murphy will be joining the program. It'll be great to have him. Today's agenda, Jesse's going to start us off after the news and headlines, Jackinthebox first symbol, and finally we're going to finish with a segment we're calling U-Turn, and we'll get into that when we get there, but I think you'll find it very interesting. All right, Tom, technical news and headlines, off we go.
Off we go. All right. Well, we're going to start with economic reports. I almost don't want to. You see that headline number right there at the top of your screen. May ADP employment numbers, 27,000. Market was expecting 175,000, way down from last month, way short of expectations. Really hard to paint a positive picture on a report like that. But I think the bond market's kind of been saying this all along. We've been watching the yields drop. That could be a sign of a couple of things that we've talked about, which are, lower inflation expectations, which I think is part of the deal. But it also can be lowered outlook in terms of economic growth ahead, which also could be part of the problem. So anyway, the numbers do not help. That employment number, while it's not the biggest employment number, we'll get that on Friday when we get non-farm payrolls, it still gives the traders out there something to chew on. And when you see a number like that, I'm not overly surprised that the market is moving a little bit more towards safety in terms of the sectors that are leading today. May PMI services matched expectations. ISM non-manufacturing came in just a bit above expectations. And keep in mind that at 2 o'clock today, we will be getting the beige book. So lots for traders to chew on. So far, like I said, not very good news in my opinion. But let's take a look at what's going on in the Treasury market. And we'll start with the 10-year Treasury yield here. And this is what I was just referring to. So over the course of the last month, really almost 5 weeks, and maybe even 6-7 weeks, we go back to mid-April, you can see we challenged this breakdown area around 2.60%, failed at that 50-day moving average, rolled back over, and we have seen a steady plunge to the downside in the 10-year Treasury yield. Of course, that means money is rotating into Treasuries, which is defensive by nature. So we're getting a little bit of that in the stock market today too, and the combination doesn't make me feel very good about the short-term direction of equity prices. But we got some technical areas that we'll need to focus on, and I'll get into that in just a couple minutes. First, let's take a look at some of the earnings reports out. Last night, Salesforce.com came in with a really strong number, although that's the number you see on your screen, 93 cents per Zacks. But I think it may have been on Bloomberg or Briefing.com. I think that there was a different number, 66 cents, but still it was a beat. They also came out with revenues that came in ahead of expectations with mixed guidance going forward. They lowered Q2 earnings per share, but they raised guidance for fiscal year 20, both in terms of revenue and earnings per share. So Salesforce got a little bit of a mixed report, better than I was expecting, to be quite honest. We'll take a look at that chart in just a minute. You can see several other software companies that also reported, but the one thing that's common among all of these companies here is that they're all beat in terms of their earnings expectations. So they did come in better than expected. The last one I showed there, Campbell Soup, came in with a nice number, and that was one that was featured at the very beginning of the show. Nice breakout on Campbell. We'll pull that chart up in just a moment. After the bell today, you may not recognize some of these names, but MDB is a big name among smaller cap software stocks. Been a very, very strong performer. So that's going to be one that I'm going to certainly want to keep an eye on. Also, Smartsheet, SMAR, another one that had been a really solid performer in the software space, kind of fallen back a little bit. I'll be interested to see whether or not Smartsheet can come up with their results that beat expectations. We'll have to wait after the bell for those reports. All right, let's take a look at some of these charts. And before I get into the earnings, I do want to mention crude oil. Last time I looked, and it was dropping pretty rapidly, it was down $2.50. And when I just take a look at this, now this is only through yesterday's close. The $ WTIC, light crude oil, sitting at about $53.48. Last time I looked, it was just under $51. And when you look back, not only is that continuing this downtrend here, but when you look back here, under $51, you have to go back to the early part of 2019 to get to that level. And we're not far from the lows that we saw at the December bottom. So is crude oil, the drop in crude oil, is it forecasting maybe another drop in equity prices? I don't think so to the extent that we saw it in December, but I wouldn't be surprised if we roll back over. And the reason, if we pull up the S&P 500, we are right up against this 20-day moving average. You can see we failed back in the middle part of May, rolled over, went to a new low, came back up, right now testing the 20-day from underneath. Let's see if we get through. Anytime I have a daily PPO that is moving lower on each one of these lows, I tend to look for 20-day failures. And that's what we've been seeing so far. We're right up against it right now. And if we go into the dashboard and into the sector summary, here you have utilities, real estate, consumer staples, all leading to the upside. Yesterday, we had all the aggressive groups up at the top of the leaderboard, but today it's the defensive stock. So if we get a big reversal later today and the market starts selling off and that volatility picks up, this would have been a pretty solid short-term warning signal in the near term. Again, I'm not bearish for the next 18 months because utilities and real estate are leading one day, but this is a sign to me that we need to be careful on this rally because it's not like market participants are going all in on this move to the upside. They're going in literally dipping a toe in the water, if you will, based on their preference for these safer areas of the market. Okay, MDB. I'm going to pull this up on relative chart. This is one that's going to be coming out after the bell later today. And I just wanted to point out, after the huge move up in March, we've been going sideways. But look at this move as we head into earnings. Now, I don't like holding stocks into earnings, but when you look at a relative chart, this has been one of the better software stocks. And we already know software, despite the hit it took recently, has been one of the best areas in the market to invest. So MongoDB, which is a smaller cap software stock, I'm interested to see what happens, not only when they report, but the market's reaction. If we don't get a breakout that is sustained into tomorrow's close, then I think maybe we got a short-term top in play. But if we can get that breakout, another big move to the upside like we saw with, say, Viva Systems a couple weeks ago, I think that would bode very well for MDB. We'll have to watch to see. All right, as far as some of the companies that just reported, you can see CRM, nice gap up, still got to get through the 50-day moving average. I was a little nervous about the stock because it had been performing so poorly relative to software heading into its report. It had broken down, but we did get a nice rally today with the mixed outlook. But can we get through these reaction highs, or do we roll back over? If we roll over, be careful because this has been an underperformer. GWRE, another one in the software space. Look at the move down. Look at the relative weakness here. This one topped in terms of relative strength all the way back in September. It had started rolling over prior to this report. It was actually at about a 2.5-month low, relative low, before today's report. It's bouncing back off the earlier lows, but I think I would be careful with this one as we go forward. And I do want to mention CPB, which is Campbell Soup. Here is the big breakout, or, well, trying to get above the August high, but certainly breaking out above this maybe neckline that you can see around $40. Volume picking up. It is in a much more defensive area, and you can see that the stock, relative to its peers, trying to make a breakout. Last one I want to show you, I mentioned at the top of the show, Coke leading the Dow. This is a big area of resistance at around 50. We're getting that breakout at 51, or almost to 51 now. Let's see what the volume looks like, but I do like what's going on here with Coca-Cola. All right, upgrades, downgrades. Erin, what do you have for today?
All righty, we got lots of upgrades to look at. I'm going to have the list at the end, but let's go ahead and we'll start off with, if I can get my... All right, I'm going to feature our new advanced charting platform as well. First upgrade today by Standpoint Research. Biogen was upgraded from a hold to a buy. I think this is a pretty interesting chart, to be honest. I'm going to zoom in just a little bit here. Here we are. And let's first look at the PMO. There we go. And then I'm going to go ahead and annotate a little bit here as well. So let's look at support resistance here. There's your resistance. This is a pretty clear area of support right back down here. So we've been in this trading range. And I would start looking, as you can see, the range that is written here, that is annotated here, is 2.5 to minus 2.5. And so this is where it was very, very oversold. Of course, makes sense, fell quite a bit, but we're heading back up to the top of that trading range. And notice that the PMO has bottomed above its signal line, and it looks like it's heading back up to go back over zero. So I think this probably was, this is an interesting upgrade. I could be on board with that one. Let's go ahead and look at CVS. CVS was upgraded today by Standpoint Research from a hold to a buy as well. Let's look at, I'm going to concentrate. We do have a PMO buy signal here, but I want to look at that. I'm going to look at the OBV a little more closely. There we go. And so I'll take this here. All right, so we have a rising trend here. OBV has been, unfortunately, not quite as exciting here. We're moving mostly sideways on the OBV, but I can see this breakout. This is a pretty nice little breakout in the short term. There you go. And of course, it had already broken out from this declining tops trend line Monday. So I think that this is looking pretty good for CVS. You know, it hasn't been, as we talk about a lot of times, a real sexy stock to be in. But, you know, we were talking at the beginning of the program, and the defensive areas are starting to lead. And apparently Standpoint Research is seeing some opportunity coming up here for CVS. Mosaic was also upgraded by Standpoint. They had quite a few I'm going to talk about today. Look at this nice move right off of the bottom that we saw earlier last week. And let's go ahead and look at this move. There's your rising bottoms trend line. And if we go and look at the declining trend, and we can bring it all the way back from up here, today is a nice breakout. We had the breakout yesterday, but it didn't quite get there. Now we're starting to see a more solid breakout. We're trading right here above that declining tops trend line. So that looks pretty good. Notice also we have a PMO buy signal that is just come into play as well with that breakout. So I think this Mosaic's looking pretty good right now. And again, in really that defensive area, this one, of course, in materials, which has clearly not performed very well this year, but seems to be on its way out of the darkness. Probably a lot of that having to do with gold. All right, Roku looking really nice. Looked like we were going to turn over and get a sell signal here on the PMO, but no, that did not happen. And instead, we've got it turning up. And look at this beautiful little symmetrical triangle here. And got the nice breakout from that. And, you know, you could even make a case for a flag or pennant formation here as well. And that would be a nice little move to the upside off of this support level. And like I said, we're already looking up here at the top. So I would be looking for a move. If you want to look at this as a flag or a pennant, you know, the measurement here is $70 to about $96. You can see over here on the side. So when you do the math there, you know, that's going to take us up, well, quite a ways here. $24 is what it's looking like if we continue on the path and we get the full execution of this possible pennant formation. All right, let's move over to downgrades. Oh, let me let you know, Roku, Guggenheim, neutral to a buy. They've moved their price target to 119. So they're certainly looking for some serious upside movement. And like I said, I could see a move up into the $90 range. All right, Norwegian Cruise Lines, we're looking at downgrades. And first off, it's, like I said, Norwegian Cruise Lines, Buckingham Research upgraded from a buy to a neutral. They have moved their price target from $77, which of course is off the chart here, and they've lowered it to $56. So we're looking at this area of support over these tops right there. Of course, we've broken down. I don't like the chart. Look at the PMO. It's now in negative territory. And I suspect if we look at the OBV more closely here, the volume is definitely telling us that there is some problems here. The OBV is falling as well. We haven't dropped quite below the previous low right here, but we have dropped below rising bottoms on the OBV. There we go. And there you can see that right there. Okay, and then the last one I'm going to do real quickly is RYAAY, Rainier. Really interesting. It looks like it's come off a bit of a turning point here, and I'm going to go horizontal on this one. There's our support level right back here. And it managed to drop just below that. But now we're looking at that move outside of that. We got the breakout, currently trading above the close from yesterday. We have a nice little move on that OBV. Look at the spike in volume here. You can see nice volume coming in after the distribution here that we saw in the volume earlier. So liking this one. If you want to look for the next area of overhead resistance, I think this is it. Short-term overhead resistance at the top, but that also matches up pretty nicely here with the bottoms that we saw back in March and that's all I have for upgrades and downgrades. Here is the list. I will have these up in the Market Watchers Live recap later this evening. And with that, I'm going to go ahead and introduce our guest, Jesse Felder. And I am really interested, after 15 years of being a member, how you do use stock charts. So I'm going to let you take it away. I'm going to be watching closely.
Yeah, it's for me. I have to preface this. This is my dashboard here we're looking at, but I have to preface this. I'm a long-term investor, and I have been since the beginning of my career. I worked at Bear Stearns and co-founded a hedge fund in LA and did that for a while. And it was about 15 years ago that I started studying technical analysis and kind of adding that tool to my toolbox. And started adding some macro also. So I have a longer time frame probably than most of you guys, Erin and Tom, and probably most of your watchers too, your viewers. But for me, adding technical analysis to my process has been very, very valuable for me. And so I'll just go through some of the charts that I look at on a regular basis. This one down here is probably, these are totally out of order. But you can just get a feel for some of the indicators and things that I'm looking at. Tom and I were talking about this one before we went on the air, and this is basically just the blue line is the difference between the U.S. Treasury yield, 10-year Treasury yield, and the German yield, and you can see it's very highly correlated to the S&P 500. And to me, that just makes perfect sense. The more attractive our assets are generally relative to the rest of the world, more money's going to flow into dollars and into our stock market and junk bonds and those kinds of things. So that's one thing I pay attention to the general direction of the broad stock market. This is a chart of just 10-year Treasury yields, and then the indicator at the bottom is Bollinger Band width. And for me, when I see those Bollinger Bands widen dramatically, that is an indicator to me of an impulse move. So if you study Elliott wave theory, impulse moves are generally in the direction of the prevailing trend. And so when I look for these big impulse type moves to kind of just let me know what is the overall trend in this market. So this is a 10-year, even longer, 12, 13-year chart of 10-year Treasury yields. And you can see through 2008, 2011, we had these impulse moves down in yields. And then in 13, we had a strong impulse move higher. We had another one in late 16 after the presidential election. And so far, yields have been coming down over the past, since last fall. But I'm not seeing it so far as an impulse move. So to me, the trend is still up in interest rates until we see a very strong move to the downside. And then when you look at just the long-term trend of the 10-year yield, you could see this downtrend was broken to the upside and is now being tested from above. To me, that's kind of textbook trend change type of action. Same thing in the 2-year yield. This next chart is basically the ratio of the banks index to the S&P 500 along with the yield curve. And so I remember I gave an interview in late 16 when the banks just exploded higher, after the election on deregulatory kind of hopes. And the yield curve really wasn't supporting that move. And since then, over the last, 2 years plus, banks have been underperforming, and it's all, directly related to the yield curve. Banks make money on net interest margin. When there's no interest margin to be made, that's not great for the banking sector.
Hey, Jesse.
Yeah.
I got a question going back to that bank chart.
Yes.
Is this a time, do you think? I mean, you were just pointing out that the 10-year Treasury yield broke that longer-term downtrend, came back and kind of back-tested that line that it broke out above, same with the 2-year. So do you think that this is a situation where we're likely to see those rates start to turn back up, and the fact that we've got such a narrow spread now on the yields, that is this the time maybe to be jumping into banks, do you think?
For me, yes, I do think banks are undervalued relative to the rest of the market. I have stayed away from bank stocks for a lot of my career, just because their financials are so difficult to get a handle on. They're black boxes. But to the extent that the yield curve here is potentially bottoming and starting to widen again, that should be bullish for financials generally. I personally like Annaly Capital Management. They're a mortgage REIT, and they've kind of suffered along with the bank stocks. And I think I'm more comfortable with their financials. So this is a chart of the dollar and the long bond, and you can see how we were talking about how the difference in yields between us and Germany. You can see what that makes our bond market more attractive, and you can see how bonds and the dollar are pretty highly correlated as well. It's just money flows here because of that yield disparity, and it's bullish for the dollar. It's kind of a chicken or the egg thing. Is the dollar up because people are buying bonds, or bonds up because people want to move into dollars? Doesn't really matter either way, but it's important to pay attention to those dynamics. This is just a simple breadth thrust indicator I think I got from Ned Davis. It's when you get 90% of stocks trading above their 50-day moving average. That's usually a pretty good bullish signal. And you can see I highlighted the green areas at the beginning of those periods. And then when you get back down below 20% too, this kind of, I look at as the end of that breadth thrust. We had one back, very early this year. We had one in early 16. And, that to me is something I pay attention to. Here is the difference between the premium and discount on the Central Fund of Canada, which is now the Sprott Physical Gold and Silver Trust. To me, this is a sentiment indicator towards precious metals. When the closed-end fund trades at a premium, people are really bullish on the precious metals, and when it trades at a discount, people are bearish. So that's something to pay attention to as a sentiment signal. You guys mentioned Mosaic was upgraded. To me, this is really interesting. So this is a chart of essentially the FXI, the Chinese ETF, along with Mosaic. And you can see these have been very highly correlated until the last few years. And still the price movements are generally in the same direction. But to me, I look at this over a long period of time and I go, either China's overvalued or Mosaic is undervalued, because they should trade together. And when you look at Mosaic's valuation over a long term, you can see this stock is really cheap, and there's been some interesting insider buying. So this is really kind of my bread and butter. I look for things where there's technically looks interesting, it's very cheap, and the insiders are telling me I'm right to be bullish on this thing. So you have the CFO just bought $100,000 worth of stock early last month. So that's something that I'm paying attention to, Mosaic. This is just the copper to gold ratio. Usually is a good indicator of which direction interest rates are moving. To me, it's been interesting here that we have a new low in the 30-year yield, and the copper to gold ratio has not made a new low. To me, that's potentially a bullish divergence for interest rates. But when you see on this next chart, they generally move pretty closely together. And so that's something I pay attention to from a fundamental standpoint of what way our yields headed. This is just the Dow Transports and Industrials. Here's one of my favorite charts of gold. And to me, it looks like this downtrend that started in 2011-12 broke out in 17. This sharp rally in 16 was even kind of held back by this downtrend line, broke out above it. And now we're just waiting for this 1350 level, which to me, I mean, you could kind of look at this as somewhat of a very strange looking head and shoulders bottom. But this breakout over 1350 is what everybody's watching. And I think it probably breaks above that this year for some of my fundamental things that I look at. But monitoring that is going to be important for things I do. This is just the difference between US and German yields, another way to look at it. Back to gold, to this Bollinger Band width analysis. We can see that they haven't been as narrow, the Bollinger Bands, as they are today, essentially since mid-1999, early 1999. They got Mid last year, they got really narrow again, and late last year, and now we're back to this super narrow width. To me, this tells me that we could be on the cusp of a big move. It doesn't say up or down, obviously, but to me, it tells me that things can't stay this calm for this long, typically. This is the gold to S&P 500 ratio. This next chart might help to make more sense of it, but essentially it's been in a downtrend for quite some time. But late last year in the fourth quarter sell-off, gold in relation to the S&P 500 looks like it broke out and is now showing some strength again. I monitor this ratio because there's times to own gold and times to own stocks, and usually they don't overlap. Usually, you look from 1970 to 1980, you wanted to own gold. It wasn't a great time to own stocks. Then from 80 to 2000, it was a 20-year period. You wanted to own stocks, not gold. From 2000 to 2012, you definitely wanted to own gold and not stocks. And since 2012, you really wanted to be a buyer of stocks and not gold. And just the direction of this ratio can help you understand when it's a good time to own one or the other. And so for me, if this ratio breaks above this 10-month moving average, that's potentially another bullish kind of trend following signal for gold in relation to or versus the stock market. This is the ratio of the gold mining stocks to gold, and we can see they haven't been this cheap relative to the precious metal since 2000. So to me, that's very interesting from a value investor standpoint. That gold is pretty hated, or has been for the last few years, but the gold mining stocks are probably even more so. But this ratio is also breaking its downtrend, potentially signaling that gold stocks are going to outperform the metal going forward. This is a gold indicator that I got from Tom McClellan. Tom's a friend of mine, and this is one of my favorite indicators that he has. And it basically just highlights a very interesting oversold indicator when you get RSI below 30 and the 5-day rate of change below close to 3% down. That's a signal that gold's potentially ready to reverse. It doesn't always work, like we saw late last year. It didn't work so well. But when you get these things lining up, a lot of these gold rallies have come after it's become oversold like that. Another gold indicator is, to me, something I've been watching, is tips broke out this year and exploded higher. Tips and gold usually are pretty highly correlated. So to me, that was potentially a good omen for gold bulls, that with tips breaking out, gold should potentially follow. So it has yet to do so, but still paying attention to that one. This is a buy signal from a guy named Cam Hui, humble student on Twitter. He basically has this trifecta, which is something I pay attention to. Usually marks good bottoms. It's a VIX, trend, and breadth indicator. When you get all three over these levels, it seems to be a good buy signal. This is my sentiment. One of my main sentiment charts essentially combines the RIDEX ratio and the National Association of Investment Managers investment positioning. And so you can see when these things, you get these good downdrafts here in both of these ratios, like we did in late 15, early 16. That's a pretty good contrarian signal. We got somewhat in late 18, still pretty good signal, but I think if you're looking for these longer term type of bottoms, it helps to see this type of capitulation on the part of both of these managers. Emerging markets, very interesting chart, goes back to 2007, this very important area. It's hard to believe that these things have been trading around the same area for 12 years. But to me, potentially, we're looking at a very bullish kind of basing over the last 12 to 18 months. That could be very good for emerging markets going forward if they can hold above 40 again. Another chart of the RIDEX ratio, very interesting to me to see that in 2017-18, we saw the ratio finally go back and eclipse the highs that it made in 2000, which, people say there isn't bullishness in this market. Well, when you look at this, it's hard to claim that people are maybe not talking bullishly, but they're positioned, at least at RIDEX, more bullishly, or they at least were recently, they're positioned more bullishly than they were at the peak of the dot-com mania. This is kind of an interesting chart, more of a macro feel for this one. It's basically the ratio of Dollar Tree to Macy's. And it's more of kind of an economic indicator, I think, that when we see this ratio explode higher, that usually precedes recession. We saw Dollar Tree surge relative to Macy's in 2000. That was a good recession indicator. Again, in 2008, you saw Dollar Tree surge relative to Macy's again. And since 16, really, late 15 or 2016, and some people consider that an industrial recession. We had ISM contracting and some things. And then 2017, and again, over the last 6 months, 9 months or so, we've seen this ratio just exploding higher, which to me suggests economic weakness potentially going forward. This is just the ratio of small caps to large cap stocks. When this ratio diverges from price, to me, that's a good breath warning. More RIDEX charts, I'll just skip over those. This is another interesting breadth chart that I pay attention to. It's essentially the ratio of the equal weight S&P to the market cap weighted S&P. And I find this interesting because generally the smaller cap stocks should be at least as strong as the big cap stocks. When they're not, when they're falling off, that's an important breath warning to me. And you just overlay a trend indicator on this, and you can see periods of when breadth is weak is generally not great for the broad stock market. This is a chart I shared on my blog in 2009, back in March of 2009. It's very interesting that, on a non-logarithmic scale, stocks came back to test this uptrend line that dates back to 82, tested an 87 crash, and then right there. But that also coincided with the 61.8% Fibonacci retracement of this entire bull market gain. So from whatever it was, 100 to 1500, we came back to 666, and that was almost exactly the perfect Fibonacci retracement in almost exactly a 50% extension in time of that period. So there's kind of another chart I'm looking at lately that's related to that. This is just price to earnings ratio, silver to gold ratio. Silver hasn't been this cheap relative to gold since 1993. It's another kind of interesting sentiment signal, I think, towards the precious metals. To me, this is another chart that's very important to me that I look at, is when I see new price highs made in the S&P, I want to see price highs made in bond market risk appetites. I want to see it also in sector risk appetites. You were talking about this, Tom. And also I want to see new lows in the VIX. Because when you see these three things diverge from price, it's a pretty good warning about what's going on in the market. So you see bond market risk appetites. Essentially, this LQD to IEF is a very good proxy for spreads. So when this is going down, spreads are widening, and that's a sign of risk aversion in the corporate bond market. And you can see, through these periods where we've had times where S&P's made new highs, and these things have showed increasing risk aversion instead of risk acceptance, it's been a pretty good warning signal longer term for the stock market. And we've seen that again last fall, and even at the new highs the S&P made, bond market risk appetites, sector risk appetites, and the VIX were not able to confirm those recent highs in the S&P. And also, this is just that same breadth chart. We've seen that breadth, according to the equal weight S&P, has been really lagging over the past 2 years, really, maybe 18 months in the stock market, which to me is an underlying warning signal. This is just the trend in the advanced decline line. This is another interesting chart that about a year ago, Stan Druckenmiller gave an interview where he was talking about why he went heavily short the stock market in late 2000. And he said he took a break from the market. Obviously, he's talked about this. He made a very famous mistake in the peak of the dot-com mania, where he covered all of his shorts and went long, and right the day the market topped, and lost a bunch of money, and then covered or sold all of his sold out and basically took a vacation. And he came back a couple months later and he said, I have to go short this market. And what he was looking at was interest rates, oil, and the dollar had all been rising into that mid-2000 period. And he said that was a very, strong recipe for falling earnings. And so it's something I wrote about last summer, was when he gave that interview. He said, we look at what yields, oil, and the dollar have done over the last few years, they've all gone up again. And what are we looking at right now? It's another earnings recession. I think second quarter earnings are expected to decline. First quarter earnings, I think, were slightly up. But when you look at other leading indicators for earnings, semiconductor sales, all these kinds of things are all pointing to another earnings recession similar to what we had in after 2000. This is just an oversold indicator that Investec uses. It's a very long-term thing. When you get oversold on this 18-month RSI, it's a very good buy signal typically. Here's a shorter-term oversold indicator. It's basically the percent of stocks trading below their 50-day or above the 50-day moving average or above the 200-day moving average. When you get both of these down to about 10 and 20%, it's a pretty reliable buy signal. This is another chart that I've been looking at. This is the ratio of S&P 500 to the world. And we can see the U.S. stock market has done incredibly well versus the rest of the world during this bull market. A lot of these foreign stock markets have been in bear markets since then. They have not overcome their 2007 highs. The S&P 500 has. This almost looks like a parabolic type of move to me in the S&P 500 versus the world. And if it's starting to break down, it could signal that it's time to spend some more time in overseas equity markets. Very, very clear uptrend here. And so, some people might want to wait for this lower trend line to break. Would be, I think, probably a clear signal. It's time to start buying Germany and Japan and whatnot. It's just another oversold signal here. This is an interesting indicator from Charlie Bilello and his co-conspirator. They wrote a paper on the lumber to gold ratio and how it's a very good indicator for stocks. We've seen lumber to gold, plunged. The ratio plunged into negative rate of change territory last summer. And that was a very good leading indicator for weakness in stock prices. Again, we saw this thing start plunging in April again, which has been a good tell as to what's going on with stocks. And it was a good leading indicator towards what we should expect in May. This is the other Fibo chart I was talking about. To me, this is kind of almost the opposite of what we were looking at that 2009 low, which is we've had a 6.3-year strong bull market from 2009 till mid-15. We're essentially right now at the 1.618 price extension and the 1.618 time extension of that move, of that 6-year move. To me, that would be a pretty, and I first highlighted this chart back in January of 18, and stocks have struggled to overcome this important Fibonacci extension level since that time. So to me, this is a very interesting potential turning point. I also manually count DeMark sequential and combo indicators by hand on the charts. And it was also interesting that late in 17, I think it was fourth quarter 17, we had a quarterly DeMark sequential sell signal that lined up very, very well with this Fibo chart. To go along with the foreign stock market idea, this is a chart of the Nikkei. You can see this downtrend. I mean, Nikkei peaked in 1990 and is still down, almost half, 50% from that peak. But there's this important downtrend line that was broken to the upside in 2015, tested in 16, almost perfect, trend reversal type of action. And now it's moved to new highs, and you probably draw a little support level here too at 20,000, potentially bullish for the Nikkei going forward. This is the semiconductors. This is one of my larger short positions right now. I'm a long short investor. We managed a long short hedge fund. So I own certain things and I'm short things against that. Semiconductors are one of the stock sectors I'm short right now. And you look at, we had a monthly DeMark sequential sell signal earlier this year and a huge divergence in money flow at these new highs in the semis. When you look at momentum too, there's going to be momentum divergences. Michael Oliver is another friend of mine who does some very interesting momentum structural analysis. And when you look at semiconductors from a momentum standpoint too, the momentum is really starting to wane. They're also extremely highly valued.
Hey, Jesse.
Yep.
When you're looking at an ETF like that, the SMH, do you pay any attention to the components, like Intel being the #1 stock that's within that SMH? Does that concern you at all as to which stocks are in that, or do you strictly follow your
No,
rules?
I absolutely do. I mean, so I didn't like the fact that Qualcomm, is a large component in there. Qualcomm is probably a stock that's on the cheaper side of things, but then, NVIDIA became a huge weight in the SMH last year, and I shorted NVIDIA separately outside of this because it became so incredibly overvalued. I mean, I think the stock traded 7-8 times sales at the peak of the dot-com mania. It got up to like 15 times sales last year, which to me tells me, the thing is more crazily overvalued than it was at the peak of the dot-com mania. That's something that once momentum, this is why I started adding technicals. Once momentum and things start telling me that it's a better opportunity to try and short it, momentum's waning, then that's something that I would look to take advantage of.
Okay.
Here's an indicator that I developed a couple of years ago. It's essentially correlation between the S&P and the VIX. And I was looking at this a few years ago and saying, the VIX and the S&P should not move in the same direction. And when they do, it's usually a sign of a potential trend change, at least short term. And you can see this one I highlighted back in like May 1st, April 30th. We had the 10-day correlation between the VIX and the S&P just shot up. And this is basically, it's, investors pushing S&P prices up, but also pushing the prices of options up, which really shouldn't happen. And so that's probably a sign of growing risk aversion, like some of the other indicators that I look at. And like I said, it doesn't always work, but it's a pretty good, red flag for those types of things. And then this chart is long-term chart of interest rates. And when you see rates surging up, this is a chart I got from Mehul Daya, who writes for one of the big banks. It usually coincides with some type of a crisis. We see interest rates surge up in '87, led up to the crash, Great Bond Massacre in '94. Dot-com mania peak had interest rates, surging into that. And since 2016, we've had a pretty good surge in interest rates that potentially, causes problem. The rise in the risk-free rate of return is usually what causes problems. When investors go, wait a second, I can get 2.5 without taking any risk. Why should I, buy a junk bond that's giving me 4.5? And so this rising interest rate environment is something interesting to pay attention to also. And then finally, this is just a Zweig breadth thrust indicator, similar to the other one, the Ned Davis one that I indicated. So that's pretty much my main chart book that I go through on a daily, if not at least a weekly basis, to look for interesting developments, trends in the markets.
Hey, we did have a question that came in earlier about the breadth thrusts and what it's telling you. And I saw you just finished on that one. I mean, are you gleaning anything from these, the charts on breadth?
Well, I mean, the thing with the breadth thrust is it's a very good signal when you get a breadth thrust that price is going to continue in that direction for a period of time, for several months. But that breadth thrust, those breadth thrusts that we had, let me go back to this last one here. This was back in early January. So, you just never know how long, because we went from, so Zweig breadth thrust is from below 0.4 to above 6.15 within 10 trading days. So it's just this little short move right here. It's a very bullish signal, and it obviously carried through April. But I don't think there's much to glean from it beyond that, because you just don't know how long they're going to last. If I go back to the other one, the way I use as like a disk confirmation is if stocks were to get down back to this 20%, only 20% of S&P 500 stocks trading above their 50-day moving average, that would kind of be a signal that this thrust is over.
Okay. Yeah, very, very good. I guess from what you're saying and from what I'm kind of hearing from you, I would say that you are overall pretty bearish at this point. U.S. equities?
I am, and I think that's a few reasons. One, when you look at things like the price to sales ratio, the Buffett yardstick, and I can pull these up on my site really quick. There's a few things that we can look at. The valuation of stocks is extremely high, and this is not a good timing indicator, but it tells you what the potential risk is. So this is the value of the stock market to the economy. And you can see that this is the late 60s, not a great time to buy stocks. Early 80s was a great time to buy stocks. Actually, if you flip this upside down, this indicator tells you what stocks are going to do over the next 10 years. So you can see the red line is the Buffett yardstick. This blue line is the actual 10-year, annualized 10-year return from that point forward. So you can see back here like I said, in the early 80s was a great time to buy stocks. You got 15% a year over the next 10 by just buying the stock market then. .com mania, stocks get extremely expensive, and you actually lose 2% a year or so buying stocks at that point. Right now, we're back to that same valuation where stocks have a negative expected return, including dividends, for the next 10 years. So that's one thing that, from a valuation standpoint, I look at. Then from a sentiment standpoint, you look at, for me, margin debt. John Kenneth Galbraith wrote, "There's probably no better index as to the volume of speculation than margin debt." And this is just nominal margin debt. We can put it relative to the size of the economy. And you can see in the .com mania, margin debt soared relative to the size of the economy, again prior to the financial crisis. And then very recently, margin debt went to all-time new highs relative to the size of the economy. To me, this says people are speculating to a great degree. There's over $600 billion leveraged to the U.S. stock market right now. It's a potentially bearish sentiment signal. Margin debt and the stock market are very highly correlated. And to me, an interesting chart here is in terms of potential risk in the market. I like to look at margin debt as a potential risk indicator because all of this money needs to be paid back at some time. So I look at it as potential supply coming into the market. So it's potential $600 billion of supply coming into the market. There's a decent correlation between the 3-year return in the stock market and margin debt to GDP. So you look at what happened the last time margin debt to GDP both went to these levels. We had 40% drawdowns, 50% drawdowns. So to me, this level of margin debt suggests the potential risk is another 40% or more drawdown. And what's the potential reward to long-term investors? According to the Buffett yardstick, market cap to GDP, it's roughly 0. So the reward to risk equation for long-term investors is very unattractive at present.
Okay. All right. Well, I know we got our poll, which we're going to take a look at in a minute, but we do have a couple of questions. One is, what is the whole idea behind your DLTR relative to Macy's, Dollar Tree versus Macy's ratio? Is it just, obviously a much cheaper store versus a more expensive store?
Yeah, absolutely. I mean, people are going to be shopped when things are good. People are more likely to shop at Macy's, and when things are not so good, they're more likely to shop at the Dollar Tree. And Macy's is you talked about cyclical versus defensive sectors. This is essentially a defensive retailer versus a cyclical retailer. And so to me, that's really just the thought process behind it.
Okay. I mean, maybe it would be more meaningful to have more companies rather than, because Macy's could just be doing something very poorly.
Absolutely. And yeah, you could run like discount retailers versus department stores.
Right.
And also that ratio, you're right, that ratio has soared recently because department stores generally have not been doing very, very well. So, that's part of it too.
Yeah. Also, where did you find your insider trading data? Where do you get that?
There's 2 sites that I really like. This one that I highlighted is openinsider.com. I go to that site every day. And then my friend Asif runs a site called Inside Arbitrage. InsideArbitrage.com. They both have, it's totally free to go through insider buying and selling on those sites. That's something that I've studied for a long, long time. Insider buying and selling. When you find insiders that are really good at buying their own stock and the technicals are lining up and it's cheap, I mean, those are always been the greatest opportunities for me.
Okay. All right. Well, we have the poll up here. And this was, you talked about gold earlier, and I think it's fair to say that you're bullish gold right now. And so the question was for the viewers, given the fact that the dollar's been weak and the price of gold's been going higher, do you believe that gold will break out above 1350 over the next 2 to 3 months? And, you and I and Erin, we were speculating before the show, because gold has been bullish, that we were speculating the answer would probably be yes. And that's exactly what we're seeing. You have any other comments?
Well, yeah, I think it's, we talked about before we went on the air, I think the dollar is really highly correlated to the federal deficit. That's one of the fundamental reasons I'm bullish. Widening deficit should be bearish for the dollar. Gold usually trades pretty inverse to the dollar, so that should net be bullish for gold. And then the other side of it too is if it looks like the Fed's going to cut in July, that could potentially be cut rates in the midst of kind of these inflationary pressures coming from the trade war. If you have all that, that could be the catalyst, the kind of the cocktail that would catalyze a breakout of the gold price.
Okay. All right. Well, it has been a pleasure having you on here. I know we'd love to have you back sometime if you wouldn't mind stopping by. I think all of our viewers really were intrigued by all the charts that you showed. We do like to give both sides. I mean, I talk a lot about how bullish I am the market, but I think it is very important to take a look at both sides and, kind of pick your battle lines. Let me ask you this to wrap up. Is there one thing that would change your bearish stance, or would it be the culmination of all of your charts needing to change?
Yeah, it's really a time frame issue. I mean, in the short run, I think if we were able to break above this 2013-14 area, we've had a kind of a decent oversold signal. That could be a short term, bullishness. But longer term, for me to have to get really, to take off all my hedges and be comfortable with that, I would have to see, something that would show me stocks are not as highly overvalued or or there's not that much potential supply represented by margin debt on the sidelines. So probably those charts are the ones that would have to be, for me, longer term to become structurally bullish.
Okay, excellent. Well, I do want to thank you again for joining us here on Market Watchers Live. And Jesse, we would love to get you back sometime if you'd like to join us again.
I'd be happy to. I'm a huge fan of your work, Tom and Erin. I read you guys' stuff all the time, and I really appreciate what you do. So yeah, it would be an honor.
All right.
Great. And actually, a lot of people were asking about your chart lists, your chart books. So I'm going to probably try and catch up with you offline and see if I can at least get the listing so people can create their own.
Perfect.
Mm-hmm.
All right. Appreciate it. Thanks, Jesse.
Yep. Thank you.
All right, Erin, you ready to move into the 10 and 10? Do you want to show the RRG?
I've already got it up here. Yes, there is the RRG. We had a pretty good smattering of requests. Staples finally starting to make a move here as far as the requests go. Technology still is the leader of the requests. We're going to go ahead and let's start with Jackinthebox, and then we'll move on to the most popular in the chat room.
All right. Well, first, Jackinthebox, I do like this breakout here. I really like the volume that's kind of come in on this move to the upside. Also, the characteristics of the chart now are beginning to show an uptrend. You move up on good volume, you pull back, essentially hold the 20-day moving average, and then break out again. That's what I look for. I think the other thing that I've pointed out here, and I've put it in red because I always use red usually for negative stuff. This is a positive, but I just want you to realize that this is a stock that has been downtrending relative to the restaurant and bar index for the last 10 months or so. We're starting to see an uptrend, which is great. We're getting some nice volume in, which is great. But this is the type of stock, because it hasn't been one of the best performers. If I started to see this relative strength roll back over again, and I couldn't hold, say, a breakout level or the rising 20-day moving average, I'm going to have a pretty tight leash here. So I like the stock. I like what it's doing. I like the space it's in, but it hasn't been a relative leader. So if it begins to show some weakness either on its absolute or relative chart, I would quickly pull the trigger and move back to the sideline.
All right, let's see. Well, we kind of have a tie here in the chat room for most popular. So we'll look at both of them, but we'll start with Apple.
All right, Apple. Part of the problem I'm seeing with the rally that we had yesterday and with the rally that we had this morning is number one, many of the groups that were beaten down so badly in May were leading the rally yesterday. So they were technically broken stocks. And the problem is when you get back up to key resistance levels, unless you can break through, these stocks are poised to turn back to the downside. And I think that's what's happening here so far with Apple. And I think that's what's happening across many areas of the market, like with semiconductors that Jesse talked about. They got a nice bounce yesterday, but they've been so oversold that they're just getting these little short-term rallies. So I could go through a lot of the relative strength stuff. Apple, pretty good relative to its peers, blah, blah, blah. But really what I'm concerned about is first getting back up above these initial tests of technicals, just trying to get back up above that 20-day moving average. So I'm not surprised when you get oversold to get this bounce, but now can we sustain it? Can we do something more technically? I think that's going to be a real driver for the market here in the near term is can some of these stocks that have been oversold start to show more bullish characteristics? So far, I would say that's a no on Apple.
All right. Let's see. The other most popular, interestingly enough, is Procter & Gamble, consumer staples. The viewer asks, is this the time to go into staples in the summertime?
I actually think this is a really good stock period. I mean, it's been a great performer. The group's been performing well. This is one of the areas within consumer staples that I think actually has been very nice. I mean, you can see the rally off that December bottom. And when the market was getting hit in May, this kind of insulates you a little bit from that. And you've got one of the better stocks in the space. So I don't really have any problems with Procter & Gamble. I think maybe, let me go ahead and annotate the trading range that it's in right now, which I think if you go back 102, 102.50, you've got some lows from April. And then again, at the beginning of June, right at that level, the recent high. I think you're probably just going to trade in this range in the near term. Ultimately, I would expect off of an uptrend sideways consolidation to get another breakout. So I like Procter & Gamble. I think it's a good defensive stock.
All right. Let's see. Next one up will be Halliburton, HAL.
I can tell you right now, I'm not a fan here. Or even chart up. Yeah, most of these energy stocks just, why try to swim upstream? I mean, it's the whole group. I mean, when you look at its peer group, it is at a 52-week relative low. You look at the stock relative to the peer group, and it's at a 52 low. Actually, this was an absolute chart, I'm sorry, of the peer group. Here is Halliburton relative to its peer group at or pretty close to a 52-week relative low. And then here's the peer group versus the S&P 500 at a 52-week low. I'm not going to try to be a hero and step in front of a freight train. Look at the volume coming in. This area, this stock in particular, has got tons of sellers. I can't tell you why, but in technical analysis, we don't need to know why. We are just seeing a stock that is getting beaten up, continues to drop without any sign of relative strength anywhere. So I think the first thing I would have to see is a change in terms of the relative strength here, the stock versus the peers, and then peers versus the S&P 500. I think as long as that continues, I see no hope. I mean, obviously we have hope. It's a good long-term company probably, but in the short term, I'm not interested in trading it until I start to see some relative strength.
All right. Let's see. Next one up that I am going to give you is an ETF, the home construction ETF, ITB.
Well, I do like home construction. Actually, let me just put it on a chart other than the relative chart and stretch this out a little bit. And actually what I'll do is I'm going to go out 5 years and let's look at a weekly chart. This is one I think it's helpful to kind of take a step back and look at what's going on here. At the end of 2017 and into early 2018, this was one of the best performing groups. And what I had said back then, in early 2018, I remember doing an Outlook webinar and saying, as long as home construction remains above that 20-week moving average, you want to stick with it. But as soon as it fails, you want to be really careful. And here you can see the ITB doesn't line up exactly like the home construction index, but pretty darn close. And you can see that as long as we were struggling to stay above that 20-week moving average, you just wanted to be out of the group. And I think now, if you annotate here and take a look, I think it's pretty clear that every time we get these pullbacks now to the 20-week moving average, we see that's the area that we want to be in. So I think this is a group that continues to perform well. It's a group I'd continue to be okay investing in, trading in, until we lose that 20-week moving average. And then at that point, I think you just reevaluate.
All right, let's see the next one. Constellation Brands, STZ.
Yeah, STZ got hit pretty hard with the 5% tariff on Mexico. We've come back up. We filled the gap. I'm going to have a little bit of concern here trying to get through gap resistance. A lot of volume sold off from that close when we came in. So we printed a hammer. We were already moving lower. We were already oversold. I think this is a short-term bounce. I would be careful at about 187, 188.
All right. Next one up is PPL.
All right, PPL Corp. I think this one, let me just put it on the relative chart here. But you are in a group that's been moving higher, which is great. And you got a stock now that's making what appears to me to be a pretty significant breakout to the upside. So it's been underperforming its peer group, but its peer group's been outperforming the S&P, and we're beginning to see an actual breakout. So I think this is one that you could buy on this breakout of the downtrend line, but because it's been an underperformer in its group, I'm going to have a pretty tight leash. But there, I think you can see if later today the stock were to reverse back down and close, say, near the open, I'm going to feel a little differently here, because that would be a false breakout of the 50-day, false breakout of the trend line. I think there could be some issues. But if we hold this, I think you're in a good group that's making another breakout, and this one is beginning to show some nice relative strength versus its peers. So again, if you get in, watch this relative strength. I don't want to see it rolling over. Otherwise, I think this one's pretty good.
All right, let's see. Next one is Cube Smart.
Yeah, this one I believe is in that real estate group, which has been very
specialty REITs.
Yeah, and it's kind of gone along for the ride. So it's in a good group that's been performing well relative to the S&P. It's kind of going along with its peers. And so you got a pretty nice looking chart. It's probably not the best one out there, but certainly not a bad one. So I would be okay with it. I love this almost triple top breakout. I mean, we could draw a couple of lines here, but I think 31.75 to about 32.25. You can see that area was holding as resistance for quite some time. Look at the volume in early May as we go through it. Yeah, I like this. I like the stock. I think, again, there are probably others that are better in this area, but certainly nothing wrong here with Cube.
All right. Next one is going to be Fluidigm, FLDM. Nice breakout today.
Yeah, I like the stock. I like the fact that the medical equipment group is trying to break out to about a 6-7 week high. And we have started to see a lot more relative strength in medical equipment stocks. Also, I've talked about it here on the show quite a bit. Healthcare is a great area of the market in the summer. June, July tend to be strong months for healthcare. And it is defensive. So I think that this is an area of the market that I would be considering. And I think this stock is one that will likely go higher. Now, with today's move, I think we're getting closer to a very important breakout level around 14.5. So I think after a huge move up and being almost right near resistance, I don't think this is the best time to get into it. But if you get a little pullback, especially anything back down close to that 20-day moving average, I like it.
All right. And our last one is going to be Rent-A-Center from Special Consumer Services, RCII.
All right, I think you've got a really nice looking chart here in a good space. This is one of the stronger areas of the market. This is its peers, which I think is Specialized Consumer Services.
Yes, Special Consumer Service.
Okay, getting a breakout here on a relative basis. The stock's been a great performer versus the S&P, very strong versus its group. It had a little bit of relative profit taking, but it held that recent breakout, which I think is is solid. So I think what's happening is off an uptrend. This is likely to form a cup. So I like what's going on. Maybe if I was saving it, I would just simply draw this little parabola right there, maybe right here and here, because it looks to me like it's starting to turn back up. It's in a great space. It's been a leader. Nothing bad to say here. I like it.
All right, that does complete the 10 and 10. Here are the symbols that Tom just annotated. I will have these up in the Market Watchers live chart list after the show. You can find that chart list by going to the articles tab, clicking on the Market Watchers live blog, and the link to that live chart list is right there at the top. All right, I'll be back with the final market update after this.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.
All right, it is time for our final market update right now. Markets are up today after mostly consolidating sideways. It looks like we might be seeing some breakouts here in the short term for the Dow, which is up 0.2%. S&P 500 up over 18 points, which is currently another 0.2%, also for the S&P 500. NASDAQ is rising, but it has not managed to get above its intraday high. New York Stock Exchange, we're seeing the same thing, resistance levels right there. And Russell 2000 actually spent most of the day in negative territory, really trying to push up into positive territory. Currently, Russell 2000 is unchanged. TSX is up about 0.25%. TNX is, we had that gap down on the open today, but we are starting to move up and currently have a reading of 2.13%. Volatility index is falling. We're currently under 17, reading 1656. UUP started in the negative territory, but making a nice rally actually, up 5 cents for UUP, 26.20. Gold, GLD, we had that nice gap up, but we are pulling back. Likely has a little something to do with the rise in the dollar right now, being that they are negatively correlated. USO, we can see, is having a very difficult day. We're down almost 4% on USO. It's just been a continual slide for oil, and it continues on today, currently at 1072. PLT started its pullback after that that very explosive move to the upside. Looks like we're getting a bit of a pause, and like I said, that pullback. Right now, I'm looking at that support area right there from back on last Thursday. All right, that's all I have for the final market update. I'm going to pass it to you, Tom.
Okay, I want to take a look at healthcare because we've talked about healthcare, and I actually think this is a group that you really want to, keep on your radar. Here is the 1 year chart of the XLV. So this is, pretty wide sweeping ETF that takes into account a number of different healthcare stocks. But if you notice this trend line, if we can get back up above 90 and especially 91, I think that this 2 or 3 month downtrend that we've been in would be over. And as I mentioned, when you look at it from a seasonality perspective, this goes back the last 20 years. And while maybe June and July, those numbers don't seem that impressive, when we look at it relative to the S&P 500, you can see over the last 5 years, June has outperformed every year the S&P 500. So the XLV has outperformed the S&P 500 each of the last 5 years. Almost same thing goes for July. But if we drag this back over 20 years, look at June. 80% of the time, the XLV outperforms the S&P 500 in the month of June. July, not as much. It's about 50-50, but you can see both of these numbers are positive. So these are both pretty decent months for healthcare as we go forward. So I'm watching the technical development because if we get that breakout, then I know that seasonality confirms the outperformance going forward. So that, again, that's an area that I would probably be focused on. All right, we're going to go into our final segment of the day, which is U-turn. And if you remember, a week ago, we did turning point. And so Erin and I took a look at some stocks, and we're just going to go through them pretty quickly here and just see what they have done and whether or not they have made a U-turn at that key pivot area that we talked about, where we might see a turning point, or did they break down? So, Erin, I'm going to let you start with the stocks that you pulled up last week. What do you think? Have they done what you thought?
Well, it's sort of a mixed bag, I would say. I'm going to start with AIZ. It did turn as I was hoping it would. Right here, you can see that we had set up this short-term support area, which is about the time that I brought it in. We were already looking at momentum was shifting in the right direction. And so I was looking for that breakout to the upside. Now we're getting ready to hit that overhead resistance at 104, looks like 104 and a quarter. So I would be looking closely at that. And of course, now I'm starting to see a rising wedge as well. So if we get the breakout, which there's a very good possibility we will, the scooter is improved. OBV, though, not so impressive, moving sideways. As price is starting to break out here, I would want to see a continuation of that breakout above the previous tops on Assurant. All right, the next one that I took a peek at was ECPG, Encore Capital Group. And I picked it up. I was talking about it right in here. We were hitting this support level that was coming in the short term at that May low. We did get the turn. Overall, though, if you look at it for the week, it is sort of sideways. And honestly, I'm really watching to see the turning point here with a breakout above this trading range. You could make a case here for a flag. The PMO has avoided the downside crossover. We could see it move mostly sideways. We might get a little bit of wiggly action here, twitchy. And then maybe that would be the best time to see that breakout. But I think it's still in the middle of its turning point, mainly because it is in that trading range. Double bottom right there, too, if you wanted to go that direction. Although it isn't coming in off of a downtrend, so not quite textbook, but I think it still looked pretty good. ESPR, I would say, hit its turning point. It is finally starting to head up. I was looking at the very short-term support here in that 47.50 area. We broke below that before we ended up making that move to the upside. PMO is negative right now, and you can see Scooter is starting to lose its way. So although we were in a short-term turning point, I'd watch very closely that $53 area and see if that reversal is going to continue up and maybe get that breakout. I'm not quite so certain that that's what I would see. Grayscale Ethereum Classic Trust. This one had actually started its breakout. So I guess you could say it was a little bit of a cheat in that it was already starting to turn around after coming out of this symmetrical triangle. But I was looking for the continuation. We got it. Unfortunately, we've pulled way back to pretty much where we were. And now the PMO is turning down. So I would say, yeah, it sort of hit that turning point. I probably was on board a little bit late on that one, admittedly. But now we're seeing that pullback. So yeah, it's mostly sideways at this point, but I would say, I kind of cheated a little bit. It was already starting to turn. On this one, Skyline, and I know this was actually requested today in 10 and 10, but I chose not to do it, mainly because, yes, I'm going to talk about it now. So we were looking at it right about here. We had gotten the breakout, and it was starting to pull back, but we have rising not only do you have that rising trend channel that could provide some support, the 20-day EMA was also right there, was just starting to come to play. And the PMO, although turning over, like I said, it hit some really interesting support levels here. And now we are starting to see it turn off of that. Overall, I guess you could say that it's still turning. Because we haven't gotten a whole lot of gain, I don't think, off of this one. I could be wrong. I don't know what the price was exactly when I chose it. So I'd say it's still pretty much, it's in the process of turning. So, I mean, overall, when I look at, do the tally, AIZ, I'd say, yes, it did turn. The other three, while they turned, they're still moving kind of sideways. I think they're still waiting. They're still sitting there waiting for that move to the upside. And then Sky, I think, is on its way up as that turning point. So I will pass it back to you, Tom. What happened with yours?
All right. Well, I mean, some, held, some broke down, but the whole idea, when we look at this is that on the chart, we're looking for something to happen. I mean, these are key levels or critical levels that we should be looking at to say, okay, are we going to get that breakdown or are we going to get a reversal? So the first one that I looked at last week was Newell Brands. And so we were coming down here and saw the prior low around April and thought, okay, if this one's going to turn, it needs to happen here. And we did get a nice reversal back on, this would have been, I guess, last Friday, I guess. Big reversal there. We've come back up. And so far, we are getting that turn back up. So I do think the turning point was this prior support level. We did get that push back to the upside. But to be honest, when I look at this chart and I look at the relative strength and everything, I would be using this kind of a bounce back as an opportunity to get out. If it can get through the trend line, maybe get up above that gap area here where we closed around 1640 or so, then maybe it becomes a little bit more of a longer term possibility or candidate. But I'd have to see the relative strength continue to improve and so forth. So Newell, I think, worked out pretty well. So I would say that one turned as expected. And when I say as expected, I'm looking at these more from a bullish perspective. I have more of a bullish stance longer term in the market. Now, I don't necessarily think that Newell is a bullish stock, but I do look for more bullish outcomes because I'm overall bullish the market. Okay, let's see. The next one that I had was CLNE. And this one, I was looking for the first level I was looking for, I think, was up here around 270 or so. And I indicated, okay, if we fail there, the next step would probably be the top of this gap support, which is down below 260. Well, the 270 came and gone, or it might have been 275. I'm not quite sure of the level, but it was right around this previous low in mid-May. We lost it, and you can see over the next few days, we went right back down to the next level. I would say now that it is at another key turning point. I think anything below this 260 area down to about 255, I think this is going to be a critical area for CLNE. But in this case, I would say it broke down. It did not hold its recent support level. Gap support failed, price support, and so forth. Domo, and we've talked about this stock quite a bit, so I won't spend a whole lot of time here, but this was a key area coming down. Could we hold $34? Look what happened when it didn't. Quickly fell all the way back down to gap support. And like CLNE, I think it's at another key area of potential turning point. DQ, I mentioned last week, but it wasn't a stock that I was saying was at a turning point. I actually used it as an example to show what these turning points look like when they actually work. The next one I had was Fluent, FLNT. And I was looking, this was big volume, this selling just below $5. That's where the buyers came back in and sent this stock quite a bit higher. So I was looking at maybe $5 potentially holding. So as we were getting down close to $5, I thought that could be a turning point. You can see that this stock has remained very weak. And look at the relative strength just breaking down throughout the month of May, not just versus its peers, but also versus the S&P 500. It's just not been a good stock. And it did not turn, so it did break down. VRA, Vera Bradley. This one talked about this gap support and these recent lows. We did go slightly below here, but I really like that reversing candle. That's a bullish engulfing candle off of this downtrend. So technically, I guess we did break down, but I would say based on that reversing candle that we've had a pretty decent turn. And I actually think this is now at a turning point at $12. More of a bearish turning point because this is an area where we have failed in the past. That's the 50-day moving average. And so far, you can see that long tail above it and coming back down. So I would think we might be at a turning point, a more bearish turning point on VRA here. We'll see if we can get through. Oracle, I just have a few more here. Oracle went a little bit below. I believe the low I was looking for was just below 51. I don't know if you want to call this a turn. I would say that it broke down. It did go a little bit below here. But nonetheless, we did see a quick reversal. And I think, again, here's your turning point. This is what I've been talking about really throughout today's show. These failures at the 20-day moving average, I don't like them. This is more of a bearish type of a reaction when you get to that 20-day moving average, starting to look more like a downtrend when you see these failures. So I think we want to be careful. SND, this one definitely turned, went back up. Now, remember, this was a short-term support area. I was saying 325 is the level I would watch. I think it was during this candle when it was trying to reverse. It did go up the next day and get almost to that 20-day moving average where, in my opinion, that's the next turning point. And then we came back down. You can see now getting a big breakdown here on SND. ULTA, Alta, nice reversal with the earnings report. I think we broke down below this 328 level, though. It didn't hold. After earnings, we got a test of the 20. I'm going to be watching that 20-day here, as I am with a lot of stocks. And then finally, HDS. This one came down to that prior level that I had pointed out back in mid-March, and it did make a reversal. But again, look what's happening. It gets that move back up. Nice $2 pop, 5%. But we're getting a bearish engulfing candle at the 20-day. I think we got to be careful here. So let's just give you a quick summary. These are the stocks, and the question is, did it turn? Some made that U-turn, Erin, and
yes.
some didn't. And
absolutely.
Yeah, so again, I think, go ahead.
No, I think, when we talked about it a little before the show, sideways, turning, even some of those quote unquote breakdowns, a lot of them are just still sitting at that turning point. They just haven't actually made that move to the upside, still waiting on it. I think it's interesting, and revisiting some of our segments, I think, is something we'll have to do in the future.
Yeah, we plan to do more of this going forward because, hey, sometimes you make good calls, sometimes you make bad calls. It's all part of the game. I think just as almost every one of our guests and colleagues at StockCharts have said in the past, it's really about managing risk. It's not about being right all the time. And so when I'm looking at a stock, many times I will buy a stock at what I think is a turning point because I'm anticipating that move is going to be made back to the upside. And so until, the market proves to me otherwise, and if it does prove to me otherwise, I got to make sure I keep my stop in play. But that's something to, that we'll continue to do as we go forward. We do want to go back and take a look more. And we do that with Monday setups, but we have so many segments where we talk about a number of stocks. I think it would be really healthy to go back and take a look sometimes at how they did. I think we can all learn from it. I think it's an educational exercise.
Absolutely.
All right. Well, you can see the market has bounced back here. We have got the Dow Jones Industrial Average currently up 159, NASDAQ 37, S&P 17. So the rally that we have been seeing yesterday and earlier today continues. I do want to pull up that S&P chart because we are right at that 20-day moving average. And again, if you weren't here earlier, one final comment. If you go into the sector summary, you will see that the leadership today, by a pretty wide margin, is coming from defensive stocks. And that does bother me, Erin.
Oh, yikes. Definitely.
Yeah.
I mean, look at those moves, almost 1.25% or higher for all three of those too. Wow. Yeah,
and you want to see the market taking risk. You want to see traders, investors taking risks, and that gives you the exact opposite feeling. So not good. But let's go ahead and wrap up. I do want to thank all of you for being with us today. Please remember to complete the survey as you exit. It's located below the video player. Special thanks to Jesse today for joining us. Really enjoyed his presentation. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody, and we'll see you back here tomorrow. Happy trading.